I've worked with a lot of clients over the years that have received company stock as part of their overall compensation. Of course, many times when this is sold, it qualifies for long-term capital gains, which gets special treatment in the tax code. But this generates a lot of questions from taxpayers, such as, will a long-term capital gain push my other income into a higher tax bracket? Well, that's what we're talking about today with examples. Let's get going. Now, if you're watching this video, obviously you understand there's a difference in the tax rates on ordinary income versus long-term capital gains. Now, I just want to touch on what the tax rates look like for tax year 2023 because we're going to reference some of these numbers in the examples. So if you look up at the screen, at the table, here are the tax brackets for ordinary income. Again, in 2023, in the left-hand column, we have the income thresholds for individual filers. And in the right-hand column, we have the various income thresholds for married folks filing a joint return with all the various marginal rates in the center. Next, let's contrast that with the brackets for long-term capital gains. You can see that up here in the table. Again, 2023, individuals in the left-hand column, joint filers in the right-hand column with the tax rates in the center. Now, naturally, everyone gets excited about the first tax bracket, which is 0% for long-term capital gains, up to the $89,250 threshold for joint filers. Now, one thing we're going to talk about more in the examples is this is for taxable income. So make a mental note there. But this 0% long-term capital gains bracket brings up a lot of questions in people's minds, such as, what if I have other income? How do these two types of income interplay with one another? You know, if my capital gain is $89,250 and I have another $100,000 of wages, how does that work? And likewise, what if my capital gain is $1 over $89,250? Is that going to push my entire capital gain into this next bracket? Well, those are the things we're going to look at in the examples in just a moment. Now, I want to show you one final table here before we jump into the examples because we're going to use a version of this as we look at those different scenarios. So this table puts the tax rates for ordinary income listed in the center next to the tax rates for capital gains. Now, of note, these income thresholds here are for married filers, but if you're an individual, just replace these with the thresholds for an individual, and you'll have the exact same chart, if you will. We're going to focus in on the bottom half of this in the examples, but just real briefly, I want to touch on this to make sure folks understand it. Obviously, in the center here, the first tax rate for filers is 10%. It goes up to $22,000 of taxable income. So this is the top of that bracket. Likewise, in this second bracket, which is 12%, that goes up to $89,450. Now, the reason there's a slash here is the 0% capital gains tax bracket, this first one at 0%, the number just coincidentally is nearly the same. It's $89,250. So that's just how this works. That's what we're looking at. Next, let's jump into the examples. Now let's jump into example one. We're talking about Bob and Sally here. We're going to assume Bob retired halfway through 2023, so his income was relatively modest at $60,000. To pay his living expenses for the remainder of the year, he wasn't working. He sold some stock and captured a $50,000 long-term capital gain. We're going to assume Bob and Sally are both under 65 and they're just taking the standard deduction, which is $27,700. Next, let's look at how that combination of income is going to flow through their tax return. So obviously Bob's wages are going to go up here on line one of the 1040. There's the capital gain for a combined adjusted gross income of $110,000. And like all U.S. taxpayers, Bob and Sally can either itemize or take the standard deduction. Like we said, they're taking the standard deduction, giving them a total net taxable income of $82,300. But the real question here, which is the purpose of this whole video, is how is this income going to be taxed? Because it is a combination of ordinary income and capital gains. Now, to answer this question, we need to touch on the so-called ordering rules, which are essentially the principle the IRS uses to make this determination. If you have multiple types of income, how are they actually getting taxed? And the way it works is ordinary income is always taxed first, with capital gains coming on top of that. And what that means in practice, and this answers the question of the video here, can a capital gain push ordinary income up in the marginal tax brackets? And the answer is no, and we're going to see more of why in a moment as we look at some illustrations. Now let me help you visualize this and show you the actual rates that this income is going to be taxed at. For Bob and Sally, here's how things break down. And I should also mention, per the ordering rules, any deductions are going to first offset ordinary income. Therefore, in Bob and Sally's case, here's the W-2 wages, and here's the standard deduction, reducing that ordinary income, down to $32,300, which of course leaves the capital gain there for this combined taxable income of $82,300. Now finally, let's look at the tax rates that are actually going to be applicable to these two different types of income. Remember, the ordering rules say that ordinary income is taxed first. So Bob and Sally have $32,300 of ordinary income, which is going to fill up the 10% tax bracket and be partially taxed at 12%. Here's the best way to visualize this. You're paying a blended tax rate on this first batch of income, if you will. Now, it's also important to point out that these rate thresholds are for total taxable income. In other words, any capital gains are going to stack on top of this ordinary income. So the way to visualize this is the next $50,000 of long-term capital gains, although it's taxed on the right-hand column, the bottom of this is starting on top of that ordinary income, which was already taxed. However, fortunately for Bob and Sally, because $82,300 of total taxable income, it's still below this rate threshold, their long-term capital gain for 2023 is still all going to be taxed at 0%. Now, I want to emphasize one last point here, which again answers the question of this video. Can the long-term capital gain push my ordinary income up in the marginal brackets? And as you can see, the answer is no, because per the ordering rules, this ordinary income is always going to be taxed here first. Regardless, even if your capital gain was $1 million, remember that always stacks on top. Okay, so you're not going to push any wages into these higher marginal brackets by selling stock. However, there are some caveats for people drawn Social Security or on Medicare. I'm going to touch on that at the very end. Now, I have one final example that we're just going to use for comparison purposes real briefly. But before I do that, I want to touch on a question that I know is going to come up, and that is, where do I find this within my tax return itself? In other words, where is this reconciliation if I have multiple types of income actually done? And the answer is, it's done on this worksheet, which is called the Qualified Dividends and Capital Gain Tax Worksheet. And these forms are always written, the language that they use is kind of confusing, but basically you can see here in line 9, they show how much of the capital gain is actually being taxed at 0%, which in our first example, it's the entire amount. And if you go down further on this worksheet, there's the 15% rate, there's the 20% rate, and down here is where they calculate the amount of tax owed on that ordinary income. So this is where you're going to want to look if you actually want to find this within a tax return. Now let me show you one other example that illustrates paying capital gains across multiple capital gains tax rates. We're just going to change the number slightly. We're basically just going to increase Bob's wages to $100,000. We're going to keep the capital gain the same. So this is how it plays out. As we talked about, deductions are always going to first offset ordinary income. Let's take a look at the rate that they're actually going to be paying. So Bob and Sally have $72,300 of ordinary income. You can see that filling up the first bracket here and a good chunk of the second tax bracket. Again, capital gains stack on top of ordinary income. These rate thresholds are based on total taxable income, which is the combined amount. I think that's one of the most confusing parts of this whole issue. But nonetheless, what that means is their $50,000 of capital gains are going to be taxed at two different rates. Part of it, $16,950, is going to get taxed at 0%. that fills up that 0% capital gains rate, and then the rest is bumping up into the 15% bracket, which means $33,050 is taxed at 15%. So the last thing I just want to point out here, and this is a question that comes up to people, is, what happens if I break through this threshold, this $89,250? Does my entire capital gain push into this? And the answer is no. You end up paying a blended rate. It's only the dollar amount above the rate threshold that you'll pay at this higher tax rate. Now, the last thing I got to hit on here are some tax traps for retirees. So even though we said capital gains cannot push ordinary income up into a higher tax bracket, and we showed why, there's some caveats here if you're drawing Social Security and are on Medicare. Now, specifically, if you're on, let's say Social Security is your only income, so your income is very low, you're not paying any federal income tax. Well, if you're thinking, well, hey, I'm going to therefore take a capital gain and try to fill up that 0% capital gains tax bracket, you're thinking you're going to be clever. The problem with that is it's going to result in all of your Social Security all of a sudden becoming taxable. So that is a classic tax trap that retirees need to look out for if they're not paying any tax on their Social Security. The other one, of course, is if you're on Medicare. Medicare is based on your modified adjusted gross income, and capital gains do push that number up. So if it pushes it up enough, you could get hit with a Medicare surcharge for an entire year, which is also known by this acronym known as IRMA. So anyway, it really can pay to do proactive tax planning, and that's a huge part of what I do for my clients. I've seen a lot of cases where people just don't know about this stuff, and all of a sudden they don't know about it until they file their tax return and they end up with a nasty surprise. So this is where proactive planning can really be valuable. Wow, that is a technical subject. I spent a lot of time putting together all those tables and so forth, so I hope it was helpful and earns a thumbs up from you. If you got any questions, drop those in the comments. I try to answer those the best I can. As always, I just want to say thanks for watching. We'll see you on the next one.